Welcome to the InterMarket Analysis video update. This is a weekly video that is prepared that's meant to supplement the daily video update full-length version, where we look at different markets outside of the stock market just to see how they're acting, and we can then get some insight as to what may happen in the S&P 500. This is being prepared for Monday, September 19th. The first thing that I like to go through is just a quick update of the valuation. This is a long-term chart going back decades, and it shows on a trailing 12-month basis, is the market considered to be expensive, inexpensive, or undervalued? Well, when we're up at this red line and when we go above that, the market is considered to be expensive. When we come down to the blue line, that's a PE ratio of 15, and the market is considered to be fairly valued. And when we drop down to the green line, that's a PE of 10, and the market is considered to be inexpensive. Well, you can see on this chart that we've been expensive for a long time. And there's other measurements that we use that also suggest that on a historical basis, the market is still overvalued, even though we've dropped down a little bit below the PE ratio of 20. The next chart is also a historical chart, just going back to 1980 and showing different events that have occurred and what the valuation of the market was at that time, and it's updated with the current values. Also, in past videos, I've provided the possible positive scenarios. Well, we're in a real downtrend right now, and so these scenarios are pretty much on hold for the time being. I do post these videos in the full-length version of the daily video update. So if you want to keep in touch with what's happening, please watch one of those videos. But I won't be covering those charts in this video. It's really irrelevant at this point. First of all, let's look at growth versus value. And we saw growth starting to make a bit of a comeback as we were going through the summer. Well, now it's going into a downtrend, and lately it's dropped below the 50-period moving average. This red line is the 200-day moving average, and we've dropped below that. So we are in a downtrend when we look at growth overall. Value, which had been doing better, is also in an overall downtrend and really suffering some losses as of late. We take a ratio of the two. The top chart is the growth versus value, where it had been trying to come back. And growth stocks, these are the ones that really make the indexes go higher. These are the big tech companies, the companies where you can buy low and sell high. And when they start to suffer, that's when we see the indexes start to go down, as well as individual stocks. Well, growth has really been underperforming and continues to be in a downtrend, where the value stocks, these are companies that tend to do a little bit better in down markets. Well, they've been in an uptrend for most of 2022 and continue to outperform growth stocks. Here's another look by doing a ratio of the pure growth index against the pure value index and showing how growth has really been underperforming. It was trying to make a comeback, but has run into some difficult times. Here's an inverse of that same chart showing how value has really been outperforming growth. The next chart also measures the same thing, but uses ETFs instead of indexes. It's also showing that we are in a downtrend. And here's an inverse showing where value is in the uptrend. There's another way by looking at another index showing how growth has really been underperforming value. So looking at some other markets, these are the biggest software companies in the US, and they continue to be in a downtrend. It looked like we were starting to make a comeback. It looked like the 50-period moving average may have a chance of crossing above the 200. Well, that has pretty much broken down at this point. This is a monthly chart looking at inflationary stocks against deflationary stocks. And based on this method of measurement, it still shows that inflationary stocks are tending to go lower. So we're looking at a more deflationary type of an environment. Then this is the Baltic Dry Index. And this takes into account what does it cost to ship things from one place to another place, usually dry goods or raw materials that are used to produce things. And we have been in an overall downtrend, but we've started to see this coming back up. So this is another gauge that is used to measure inflation. We also look at the CRB index, which also measures inflation. And even though it's come under some recent weakness, it's still in an uptrend. But if this continues, we might fall below the 200-day moving average and eventually see a death cross here. Looking at some commodities, here we have corn, which had really spiked up, came down, and now it's continuing to go back up. Here is aluminum, which has also really spiked up recently, fallen quite a bit, and it still continues to fall. And we have heating oil, which has dropped a little bit, but still remains pretty high. Gas, and this is kind of the political play right now, where it really was spiking up because all of us feel that. We see that every time we drive, every time we fill up. Well, we have an election coming up here in a couple of months, and so it's in the politicians' best interest to have gas prices lower. And so what they've been doing is taking the reserves out of our backup that we use for national emergencies and then using that to lower the price of gas because there's more of a supply in the market. Now, some people really think that was the right thing to do because people need some help. Other people say, no, we're supposed to touch that only when there's an emergency. That doesn't really matter. This is what's actually happening, and it has been driving down the price of gas lately. So that's really showing a little bit of relief. We also look at natural gas, which is still pretty high. Even though it's off of the high prices that it had been giving us, it's been coming down off of that. Here's oil, which they're also trying to keep lower. We're down below 85 at 84.76. And wheat, which really spiked up, came back down. It's starting to go back up again. Another chart that I haven't shown in a while, and this is fertilizer. And this really affects farming because we have to use fertilizer to grow a lot of the things that we need. And it had really spiked up earlier in the year. And it's still quite high based on where it has been recently, but it is well off of that high currently. Lumber, another thing that we use for building, of course, it's been in an overall decline through 2022. It did spike up, but has now been coming back down. And these charts and the ones that are declining, this is giving way to this scenario that maybe inflation has topped and it'll start coming down. And when the market starts to believe that, we've been going up, only to have either a speech from Jackson Hole, Wyoming, wherever that was, when Fed Chair Powell said, no, we're going to keep raising interest rates as long as we need to. And then this past week, there was a lot of anticipation for the CPI coming out. Well, it ended up not being as low as the market had hoped, and we really tanked overall. Also, the dollar, because interest rates are going up, that makes the cost of dollars more. And so it's been really strong and it is a pretty solid uptrend, especially when you compare it to the Japanese yen and the euro. And it's even doing strongly against the British pound, which kind of has been in the news lately with the passing of the Queen. Here's the euro, which has really been in a decline as the dollar's been really advancing. And it looked like maybe we topped out with the dollar only to start coming back down. Well, then something happens and the dollar just keeps going up. And then here is the Japanese yen, which continues in its decline, as well as the euro, and then the dollar, which has been advancing. Here's copper. This is kind of the barometer of the economy. When it's going up, the economy tends to be doing better. When it's going down, we tend to see a weak economy. Well, we've been going sideways a lot, even though copper is in an overall downtrend. Now, another thing that we measure is copper against gold. And copper has been outperforming gold as of late, but it's still been underperforming overall, even though gold's been having a lot of trouble too. Here's another look at that same chart, only long term. And what we like to do is measure the ratio between gold and copper to the 2-year Treasury yield. And these tend to move in the same direction. And a lot of times on this chart, if the scale is right, they tend not to get very far apart. Well, look at how far apart we are now. So does that mean interest rates are going to come down, or the gold copper ratio, which means gold goes up? And that's usually what gold does during freaky times, but it's just not doing that right now. There's one of these is going to give at some point. We've seen a little bounce up in the ratio as of late, but they're still very far apart. Here's gold itself, where it's in an overall downtrend. it's really been declining, even though on Friday's session, it bounced up a little bit over 0.5%. Silver is also in a downtrend, but it bounced up nicely over 2% on Friday, but it's still been showing a lot of recent weakness. Looking at some indexes, this is the CRB index, which measures inflation or commodity prices against stocks, the S&P 500. Well, the CRB has been really outperforming, saw some weakness, and now it's starting to outperform stocks yet again. Here's the inverse of that, showing how the S&P 500 has really underperformed the CRB index, and the ratio is still in an overall downtrend. Here's the NASDAQ 100, which are growth stocks compared to the S&P 500. When the NASDAQ 100 is really going higher, that's when we see higher index prices. Well, it's been going lower, especially in relation to the S&P 500, which is growth and value stocks. Looking at some other stocks, here's the mega cap. These are the big ones: Apple, Google, Facebook, the really big companies. Well, they've been really struggling in 2022. Looks like they were trying to come back. They came down, a little bit of a bounce, and now the downtrend is continuing. Here's the S&P 100, which are mostly growth stocks against the rest of the S&P. It's been underperforming for quite a while, even though it's bounced up a little bit recently, but it's still in an overall downtrend. Small caps, which a lot of times we get some support from that. Well, they've been really underperforming the S&P, even though this is still an uptrend. If we stay below these two moving averages, we will see a death cross for this trend. Low volatility stocks. These are the ones that tend to hold up better when we're seeing declines. And you can see in this chart, even though we've been down, we haven't been falling like the S&P has been falling. And these are safer stocks that people like to get into, not necessarily because they'll go up, but because they'll go down less than some of the growth stocks. Now, we look at a ratio between the low volatility and the S&P 500, where the low volatility stocks are continuing in their uptrend. After seeing some recent weakness, it's now looking like that uptrend is resuming. And we have the Dow Jones Composite Average, which is the Dow, the transports, and the utilities. They're really showing some weakness and are still in an overall downtrend. Here's Dow theory, looking at the Dow and how it's been declining. The transports, which set a 52-week low in Friday's session, that's after FedEx came out with some pretty negative news. But utilities have been holding up a little bit better. And I have another chart to show that. We're seeing a little bit of a divergence here when it comes to utilities. Now, some folks don't use utilities as part of Dow theory. They mainly focus on the Dow and the transports. Well, I include the utilities in here because it's a pretty important part of our economy. And even though they've been declining, they haven't been falling like the Dow and especially the transports have been lately. Here's a longer term look. We look for divergences, either positive or negative. Well, we can see how the utilities have been holding up a lot better. The Fang stocks, this is Facebook, Amazon, Apple, Netflix, Google, and they've even added more stocks to this. They're going to have to come up with some other name. This still continues to show weakness in this particular index. And ARK, which is very popular with a lot of investors, after trying to build a base and stage some kind of a comeback, it's still in an overall downtrend and is well off the highs that were set back in 2021. Looking at bonds, we're not getting any support from bonds. This is the total bond ETF, where it's coming down and possibly getting ready to break support. Where this chart's even a little scarier, this is the World Bond Index, where we've actually broken below the COVID low here. And that is not good because as bond prices go down, interest rates go up. Here's a monthly chart comparing stocks with bonds, where stocks, as bad as they've been having the year in 2022, they've still been outperforming bonds overall. Here's bonds relative to stocks and some of the shorter maturities. And it tried to go and make a golden cross here for an uptrend, but then it fell back down and we're kind of chopping sideways right now, but they're just really struggling. And here's the stock to bond correlation. If you've watched any of these videos before, I changed some of the settings in here. I was going with a 20 period calculation. I didn't think that was moving quick enough. So I switched it over to a 10-period correlation. And this is showing that stocks and bonds are having a tendency to go in the same direction, but they're just coming out of a neutral reading, which means if stocks are going down, bonds are probably going down. And if that continues, this relationship will get stronger. When they're going in opposite directions, we'll see this really fall down closer to a -1. Here's the Dow Jones Corporate Bond Index, which is really having some problems right now. And here's the S&P 500 to the 10-year Treasury Yield. This just shows how stocks have been really declining as interest rates have been going up. We started to see some improvement, but now things are going back to the way they had been. Junk bonds, this is what folks get into when they're looking for higher yield, which also means that they're taking on more risk. This ETF tends to follow stocks. So as junk bonds are going down, that's mirroring what we are seeing in the S&P 500. And here we have a ratio between junk bonds and treasury bonds, which are considered very, very safe. Junk bonds continue to outperform, even though both have been really struggling. Here are yields, and this is a daily chart just showing how the different maturities have really overall been climbing. And here is a weekly chart showing some international yields based on the 10-year yield, where the US has the highest yield so far, followed by the UK and then Germany. And then Japan's kind of its own different story right now. They're purposely trying to keep their yield really flat. And it was even negative here for quite a while, as was Germany, because they were trying to stimulate the economy. Well, now things are just kind of going out of control. And so they're trying to raise interest rates as fast as they can to get inflation under control. All right, some different sectors. This is one of the newer charts where we take the S&P 500 and the utilities ratio. And when this is going up, that means the S&P is outperforming utilities. When this is going down, that means utilities are outperforming the S&P. And we continue to fall right here. We're not seeing this turn up currently. Utilities have been holding up. And this is a suggestion that things are still quite negative in the S&P 500. Staples, the things that you have to have, they've also been showing some recent weakness, and it doesn't know what to do. We go below the moving averages and then above. And so you've got a real confused market right now. Here's the energy sector, which has been the better performer in 2021 and in 2022 compared to the S&P 500. After seeing some weakness, it has been roaring back. And here's the tech sector all by itself. This is what folks like to get into for growth stocks. And typically it's been doing quite well until we got into 2022, and it still continues in a downtrend. It got right back up to the 200-day moving average, similar to what happened with the 50-period moving average in the S&P, and then we've been declining. It came back up to its own 50-period moving average and then has been declining. So this is kind of scary looking right now technically. Here's semiconductors, which is a big part of tech. It's also in an overall downtrend and has been showing recent weakness. Here's the tech sector to the S&P, where tech has been really underperforming the rest of the S&P 500. Some other areas to look at, this is growth, which has really been suffering, against bonds, which has really been suffering. And so growth has really been starting to decline. These are both areas that have really suffered a lot in 2022. Growth was starting to outperform, only to be coming back now after having a recent golden cross. Here's the 10-year Treasury yield. So this is interest rates going up faster than the tech sector, and so it's been underperforming. And here's the tech sector, just an inverse, showing how it's been underperforming the rise in interest rates. Looked like things were starting to improve, but now things are not looking very good again. Discretionary, the things that make life fun, against staples, the things that you have to have. This has been an area that's been holding up better. We look at this every day in one of our scenarios, and discretionary is actually doing okay. It's not doing great. It just got hammered through most of 2022. But even though it's still in a downtrend compared to staples, it isn't really declining like what we're seeing on some of the other charts. And here's just an inverse showing how staples have been performing quite well. They're still in an uptrend. They did show some weakness, but now they're starting to turn back up slightly. But still, discretionary's been hanging in there lately. The energy sector to the tech sector. The energy has just been going to the moon, while the tech sector has been going the other direction. And so they've really been outperforming as far as energy in 2022 after some weakness. Now it's starting to look stronger. Here's gold. Everybody says, get into gold when times get crazy. Well, what's gold doing? It's not doing very well right now. It's actually starting to underperform the S&P. We had a nice golden cross here last spring, but then we've been declining and we're getting ready to see a death cross when compared to the S&P 500. Here's the gold to the dollar. The dollar's been doing really well. Gold has been going down. And so that's why you're seeing this really decline on the daily chart here. High leverage loans. If these riskier loans start to become a threat, we would want to see this still come down. If things are looking okay and these risky loans are hanging in there, we would want to see this going higher. Well, it's still in an overall downtrend, but it hasn't really fallen down as much as some of our other charts. Intermarket analysis. This just shows how oil has been the best performing going back to the beginning of the year, followed by the dollar. And then we have gold, stocks, and bonds, which are negative. Looking at some indexes. This takes the American Stock Exchange, the NASDAQ, and the NYSE. It takes a 5-period moving average of their highs minus their lows. And when we're above zero, we're positive. When we're below zero, we're negative. And this is a broad market look. And we have really been declining. But we're not giving an extreme reading, which this often happens at market lows. Well, we've got a long way to go before we're getting any kind of an extreme reading currently. Small caps, which are decidedly in a downtrend and have really been suffering as of late. They were able to get back above their 50-period moving average. This is when the CPI came out and the market just tanked. Now we're coming back down to this S1 level. Same thing with mid caps. The market, when I did this video a week ago, things were looking a lot better. Well, then Tuesday happened and took everything decidedly negative. And the Dow also showing some recent weakness, as well as the NASDAQ. It actually came down to S1 and was able to bounce up off of that. This is actually potentially a little bit positive. This is a daily chart here. And you see where we had the open, we set the low, but we actually closed at the high for the session. And you have this bar that's kind of all by itself. So could that be something that gives the market support? And we're seeing a very similar situation. It's hard to see with the volume here. And the reason this is so high is that the previous Friday before I recorded this was options expiration. So we see a real spike up. So it's kind of hard to tell. Here's a Wilshire. This is a broad market base where it's showing the weakness that we're seeing, and we're coming down to a support level. These are all stocks, both within the US as well as internationally, still in a real solid downtrend. Emerging markets, not really helping. These are stocks that folks like to get into to get some diversification. Well, they've been doing not very good as well. Here's an international look where China had been bouncing up and now it's starting to roll over. We've got emerging markets in a downtrend, as well as Europe, Japan, and the US. So the entire world is in a downtrend right now, according to this chart. Here's another one that people thought was the answer to a lot of questions or dreams. Well, Bitcoin, after multiple head and shoulders tops, it's been coming down. It's been hanging right around the 20,000 level for quite a while. It goes a little bit up, then a little bit down. It closed just below it in Friday's session. Now, this is a little bit different. This is not a 24/7 chart. This is just while the market is open Monday through Friday. So your numbers might be a little bit different. Looking at some correlations, we have the dollar going up and stocks going down. And so they are having a pretty strong inverse correlation. Oil and the S&P 500, they're pretty much neutral right now. They're not really telling us much, as is the S&P to the 10-year yield. That's just on the lower end of being neutral. And here's the tech sector to 10-year, a little bit below being neutral, where they're having a slight tendency to go in opposite directions. Here's the S&P to the 2-year, also slight tendency to go in opposite directions after being neutral recently. So what are the things that are positive? If you've watched more than one of these videos, this particular slide has not been updated. Energy, the CRB index, and interest rates continue to be in uptrends. Then we have the whole list here of things, and you might want to pause this. It's pretty much everything else that are negative, and we're just not seeing any improvement. So I haven't had to update this chart in months because it's the same story that we've been seeing over and over again. So thank you. I hope you found this useful. Please feel free to check out the full-length video, the daily update, and I have the weekly video available. I also do a daily brief, which I just hit the high points of what's happening, because I know you're busy and not every day is full of excitement. So have a great week, and I'll prepare this again next week.